Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, we're having this conversation today ahead of a couple of two very important events. First, of course, in a few hours' time, we'll hear from Fed Chair Powell at Jackson Hole about his view on the likely path of Fed policy from here. And many of you will recall that in recent years, Jackson Hole Conference has sometimes been an important forum for the Fed to communicate how they think about policy in the quarters ahead. So that's, of course, one focus we will have. The other one, of course, is looking ahead at the week. We also get earnings from quite an important artificial intelligence bellwether company. So from a broader thematic perspective, that will also be an important market event. Now, how do we pull this together, and what should investors do or not do about it? Joining us for today's conversation to help us with that discussion is Fook Hien, who's a senior investment strategist at the CIO office. So welcome, Fook Hien. Thanks for taking the time. Let's start with the Fed. So if you're an investor, what should you be watching out for from Fed Chair Powell's speech at the Jackson Hole Summit?
Yeah, thanks, Manpreet. So we want to watch out for Powell's view on the rate cuts, like how much is appropriate and the pace of the cuts. The money markets are now pricing in 100 basis points of cuts by year end. We believe even if Powell agrees with this, we would expect the US dollar to stabilize around current levels and the US 10-year government bond yield to stay above its technical support close to 3.8%. 3.8% is a level which has held since last December. This dovish view would also likely support risk assets. However, any pushback from Powell on the market pricing of 100 basis points of cuts could see the US dollar and bond yields rebounding and the risk asset rally faltering in the near term. We now expect the Fed to cut rates by 75 basis points this year, following the recent string of weak US job market data, and this week's 818,000 downward revision in the US total payrolls for the year ending in March. Hence, we see a low probability for the 10-year yield to fall significantly below 3.8% in the near term, unless US data deteriorates sharply in the coming weeks. How the US dollar reacts is also key to watch. The US dollar index is close to testing last December's low of 100.6, having weakened almost 5% from July's high. The next support is around 99.6, tested in July 2023. We do see a low probability of the US dollar weakening further in the near term, unless US data deteriorates further. Although the US job market has weakened over the summer and the manufacturing sector is contracting, the service sector activity remains healthy, as shown in August S&P Global PMI data.
Thanks, Fook Hien. Now, let's take a look at the bond market. One asset class we haven't spoken about in some time is developed market high-yield bonds. Recently, we've seen them outperform their investment-grade peers. So, in your view, can this outperformance extend?
Yeah, developed market or DM high-yield corporate bonds, they have outperformed the DM investment-grade corporate bonds since the beginning of the year. And this has been driven by strong domestic economic growth and the prospect of Fed rate cuts. Key fundamentals such as a strong earnings growth and contained leverage have also played a significant role. These factors have improved the credit rating upgrade to downgrade ratio. Looking ahead, the likely start of the Fed easing cycle should prove supportive for the DM high-yield bonds, as a lower yield environment would make it easier for your high-yield bond issuers to refinance their liabilities. This view is supported by history, assuming the Fed is indeed successful in achieving a soft landing. So back in 1994 to 1995, after hiking rates by 300 basis points over about 12 months, the Fed pivoted in June 1995 toward rate cuts and successfully achieved a soft landing. So the average 3-month return for the DM high-yield bonds over the subsequent 12 months was 4.1%, compared to 1.2% for the DM investment-grade bonds. The main risk to monitor is that of a hard landing in the economy. DM high-yield bonds are unlikely to perform as well in a scenario where the US economy ends up in a recession.
Okay, so I want to go back to the point you made about the US dollar potentially being supported earlier. The related question here is, what about the Australian dollar? Because you want to get a sense of your tactical view and whether you see any opportunities following the carry trade sell-off.
Yeah, the RBA published the minutes of its August monetary policy meeting, highlighting that board members considered a case to raise rates, but they decided on an unchanged outcome would be the better way to balance the risk. So the central bank further stated that the policy rate may stay unchanged for an extended period, and this cautious approach is likely to support the Australian dollar strength in the coming months. However, technically, the Aussie dollar to the US dollar is now overbought, and we see 0.687 as near-term key resistance. So one alternative to consider is the Aussie dollar to the Japanese yen. This has been one of the most popular carry trades since 2020. However, the rate differentials have now narrowed as the Bank of Japan started to raise rates. Additionally, the Japanese yen is likely to strengthen further in the short term amid a further unwind of the carry trade and demand for the safe haven currency. So together with its technicals, we see room for the Aussie dollar to the Japanese yen to move lower from here. We see the Aussie dollar to yen testing support at 90.1 in the coming weeks.
Okay, well, let's move to equities now. I think in the US, we're seeing Kamala Harris surge in polls recently, which is a change from what we witnessed earlier. And while we discussed a lot of market implications of a potential Trump presidency, in your view, what are the US equity implications should Kamala Harris win the election?
Yeah, a potential Harris presidency would represent policy continuity with a neutral impact on US equities, in our view, particularly if the election also results in a divided Congress. So tax rates would rise as the previous provisions under the Tax Cuts and Jobs Act expire as planned, and Republicans would likely continue to block any significant new policies. So in such a scenario, we believe the focus for US equities would shift to the growth outlook, i.e., can the US achieve a soft landing following the Fed rate cuts? We are of the view that a soft landing can be achieved similar to the experience back in 1995 and 1998 when interest rate cuts extended the economic cycle. So this would allow US equities to extend gains and outperform global equities. The earnings growth is robust, with the S&P 500 index expected to see earnings grow 10.1% in 2024 and 15.2% next year, as per the LSEG IBIS consensus. We favor the technology and communication services sectors, which rank among the sectors delivering the highest earnings growth. And the AI theme, artificial intelligence, that remains key. And NVIDIA's earnings release midweek will be very important for sentiment.
Fook Hien. And finally, in China, second quarter corporate earnings are ongoing at the moment. In your view, have earnings lived up to consensus, and do you see any broader opportunities in the market?
Yeah, according to Bloomberg, about 23% of companies in the MSCI China Index have reported Q2 earnings so far, and they're delivering an 8.2% positive earnings surprise. So consensus EPS growth estimates in 2024 have been revised higher to 13.3% from 10.1% at the start of July. But it ticked lower for 2025 to 10.9% from 11.9% at the start of July. We retain a neutral view on China equities within Asia ex-Japan, with a deflation and long-term growth outlook being the key risk. But a pro-growth tone from the July Politburo meeting and the third plenum suggests policy support should be sufficient to support earnings revisions, providing a near-term tailwind to the equity market. In addition, consistently strong southbound flows and an expansion of the Stock Connect program are likely to provide a further boost. Valuations are also supportive. The 12-month forward PE for MSCI China is trading at a 28% discount to Asia ex-Japan equities, significantly below its historical average. We continue to see the high dividend yielding non-financial state-owned enterprises as one of the key opportunities in this context.
Okay, I think that brings us to the end of time available today, so we'll end it there. Thank you so much, Fook Hien, for taking the time to speak with us today. If I can sort of sum up our conversation, the key takeaways, number one is I think in the FX market, Aussie yen is one pair which we see as room to fall further, at least in the short term over the coming weeks as the carry trade completely unwinds. Second, of course, in the US equities, a scenario of a Harris presidency is likely one of continuity. So technology and communication services are, of course, two sectors we prefer there. And third, of course, amid the ongoing earnings season in China, absolutely some risks to watch, but we do see an attractive opportunity in high-divi, non-financial state-owned enterprises. So with that, we'll bring the podcast to a close today. Thank you, listeners, for tuning in today. We hope you found that useful, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.